Welcome to another insightful video. Today, we will delve into the tax implications of stocks and cryptocurrency. As we navigate the ever-evolving financial landscape, it becomes increasingly vital to understand the tax implications that come with various investment options. The world of stocks and cryptocurrency, each with their unique tax nuances, is no exception. We will explore these domains, shedding light on their tax implications to equip you with the knowledge you need for informed decision-making. But remember, while we strive for accuracy and relevance, we are not financial advisors. This video is meant to be a primer, a starting point for your own research. Always consult with a professional for personalized advice tailored to your specific financial situation and objectives. Now let's dive into the world of stocks and their tax implications. Stocks, a staple in many investment portfolios, come with their own set of tax implications. While stocks can be a lucrative investment, it's essential to understand their tax aspects to make the most of your financial journey. Let's start with the basics. When you purchase a share of stock, you're buying a piece of a company. The value of this share can fluctuate based on a myriad of factors, from the company's performance to overall market trends. When you sell that share for more than you paid, the profit you make is called a capital gain. Conversely, if you sell the share for less than you paid, you incur a capital loss. The tax you pay on these capital gains is aptly named capital gains tax. The rate at which these gains are taxed depends on how long you've held the stock. If you've held the stock for less than a year before selling, your gains are considered short-term and are taxed at your regular income tax rate. However, if you've held the stock for more than a year, your gains are considered long-term. These are taxed at a lower rate, which can range from 0 to 20% depending on your overall income. Now let's talk about dividends. These are a portion of a company's earnings distributed to shareholders. Dividends, much like capital gains, are subject to tax. The rate at which they are taxed also depends on your holding period. Qualified dividends, those held for more than 60 days, are taxed at the lower long-term capital gains rate. Non-qualified dividends, on the other hand, are taxed at your regular income tax rate. In essence, the tax implications of stocks revolve around two key factors: the length of time you hold the stock and the type of income you receive, be it capital gains or dividends. Understanding these tax implications can help you make more informed investment decisions. Now let's shift gears to cryptocurrency. Cryptocurrency, the digital currency that's shaking up the finance world, also carries significant tax implications. In essence, cryptocurrencies are digital or virtual currencies that employ cryptography for security, making them incredibly difficult to counterfeit. Bitcoin, Ethereum, Ripple, and Litecoin are some of the most popular ones you may have heard of. Now let's delve into the tax part. In the United States, the Internal Revenue Service, or the IRS, considers cryptocurrency as property, not currency. This means that for tax purposes, it's treated much like a house or a share of stock. When you sell or exchange cryptocurrency and make a profit, you're required to pay capital gains tax on the gain. That's right, much like when you sell a stock at a profit, you owe taxes on the difference between what you paid for the cryptocurrency and what you sold it for. But what exactly counts as a taxable event in the world of cryptocurrency? Well, it's not just selling your crypto for fiat currency like dollars or euros, exchanging one type of cryptocurrency for another, using cryptocurrency to purchase goods or services, and earning cryptocurrency as income, either through mining or as payment for goods or services, can all trigger taxable events. And here's where it can get a bit tricky. If you're mining cryptocurrency, the IRS views this as income, and it's taxed accordingly. That means you'll need to report the value of the cryptocurrency you mined as income on the date you received it. The tax implications of cryptocurrency can be complex, but they're not insurmountable. It's crucial to keep accurate records of your transactions, including when you acquired the cryptocurrency, how much you paid for it, and when and for how much you sold or exchanged it. In the end, it's always a good idea to consult with a tax professional who is familiar with cryptocurrency. They can help you navigate the tax rules and ensure that you're in compliance with IRS regulations. As you can see, the tax implications of cryptocurrency can be complex. Now, let's compare the two. Now that we've looked at the tax implications of both stocks and cryptocurrency individually, let's compare them side by side. Starting with the similarities, both stocks and cryptocurrency are considered capital assets by the Internal Revenue Service, or the IRS. This means that when you sell either of these assets at a profit, you're liable to pay capital gains tax. The amount of tax you pay depends on how long you held the asset before selling it. If you held the asset for less than a year, it's considered a short-term capital gain, which is taxed at your ordinary income tax rate. If you held the asset for more than a year, it's considered a long-term capital gain, which is usually taxed at a lower rate. Now let's delve into the differences. When it comes to stocks, the tax implications are relatively straightforward. You buy a share of stock, hold it for a certain period, and then sell it. The difference between the purchase and sale price is your capital gain or loss. The IRS taxes this gain or loss, with the rate depending on whether it's short-term or long-term capital gain. Cryptocurrency, on the other hand, has a slightly more complex tax landscape. The IRS views cryptocurrency as property, not currency. This means that even exchanging one type of cryptocurrency for another, say Bitcoin for Ethereum, is a taxable event. You have to calculate the capital gain or loss from each of these transactions, which can be a bit of a headache, especially if you're frequently trading cryptocurrencies. Another key difference is how each asset is taxed in terms of losses. With stocks, if you have a bad year and end up with a net capital loss, you can use this loss to offset your income by up to $3,000 and carry forward any remaining losses to future tax years. This helps to soften the blow of a tough year in the stock market. Cryptocurrency, however, doesn't offer this same benefit. While you can use cryptocurrency losses to offset gains in the same year, you can't carry forward those losses to future years. This can make a significant difference in your tax bill, especially if you've had a particularly volatile year in the crypto market. Lastly, it's worth noting that tax rates for cryptocurrency can be higher than those for stocks, especially for short-term capital gains. This is because cryptocurrency transactions are subject to both the regular income tax rate and the net investment income tax, which can add an additional 3.8% to your tax bill. As we've seen, both stocks and cryptocurrency have unique tax implications that can significantly impact your returns. So, whether you're a seasoned investor or just starting your financial journey, understanding these implications is crucial to making informed decisions and navigating the financial landscape with confidence. Before we conclude, let's summarize the key points discussed in this video. Firstly, we dove into the tax implications of stocks. We discovered that the tax you'll owe on your stock investments largely depends on how long you've held those stocks. If you've held them for over a year, you'll be taxed at the long-term capital gains rate, which varies between 0 and 20%. On the other hand, if you've sold your stocks within a year of purchasing, you're looking at the short-term capital gains tax, which aligns with your ordinary income tax bracket. Next, we explored the tax implications of cryptocurrency. We found that similar to stocks, taxes on cryptocurrency profits are determined by the duration of your holding. However, the IRS views cryptocurrency as property rather than currency. This means that every transaction, whether it be buying a coffee or trading for another cryptocurrency, can be a taxable event. So it's crucial to keep a detailed record of all your cryptocurrency transactions. We then compared the tax implications of both asset classes. While there are similarities, the key distinction lies in the nature of transactions. Stock transactions are straightforward buy and sell, but with cryptocurrency, the waters are a bit murkier due to its classification as property by the IRS. Remember, this is a basic overview, and actual tax implications can be much more complex, influenced by factors such as your income level, location, and specific financial circumstances. It's crucial to do your own research or consult with a tax professional to understand the nuances better. Tax planning is an essential part of your financial journey, whether you're a stock investor or a cryptocurrency enthusiast. Understanding these tax implications can help you make more informed decisions, potentially saving you a significant amount of money in the long run. Thanks for watching. Be sure to like, comment, and subscribe, and hit the bell notification to get updates anytime we upload a video.